Today, we undergraduates of the University of San Carlos presents our paper entitled Mergers and Acquisitions in the Philippine Banking Industry, an event study from the year 2010 to 2019. The content of our presentation, starting off with our introduction, followed by our theoretical and conceptual frameworks, next the methodology, and the presentation of results and discussion, and finally our recommendation.
The study aims to know first, what is the effect of the mergers and acquisitions on the abnormal returns of the acquiring companies? Second, is the Philippine banking industry an efficient market? Why or why not? And last, based on the findings of the study, what implications can be drawn for the conduct of mergers and acquisitions and to future research? In addition, this paper also attempts to identify market efficiency and the existence of efficiency gains from bank M&A through the observation of the announcement period and the stock price movement in the focus of the selected banks in the Philippine banking industry. As for our theoretical framework, we seek to know the efficiency of the Philippine banking industry, and here we have the efficiency market hypothesis. According to FAMA 1970, a market is said to be efficient with respect to information if the price fully reflects all available information regarding securities. Generally, the essence of an efficient market is built on two pillars. First, in efficient markets, available information is already incorporated in stock prices, and second, in efficient markets, investors cannot earn a risk-weighted excess return. Furthermore, Allen, Brayley, and Myers in 2011 supported the idea that a market is said to be efficient when it is impossible to achieve a return higher than the market return.
Moving on to our methodology, the study used a mixed method design with a combination of qualitative and quantitative approaches, and the usage of mixed approaches can provide a comprehensive analysis. So the researchers began the collection and analysis of qualitative data through the event study method, and as for the collection and analysis of the quantitative data, the researchers calculated the anticipated return. So for the M&A events, we are only limited to the year 2010 to 2019 with publicly available historical data, totaling to 8 companies, and the study will only measure the acquiring companies' returns. And these are the 4 BDO Unibank acquiring different banks with the different events, PNB, China Bank, PBB, and RCBC. Moving on, this study is also an event study that will gather news and reports and stock data and market index from the PSE and Refinitiv data stream. The researchers will identify the merger and acquisitions transaction and utilize a short-term event study with an estimation window of 120 days and an event window of 11 days, which apprehends the effect of the acquisition. So the event window begins from 5 days prior to the announcement date to 5 days after the event. So the announcement date will only be the basis for the event window. So the researchers will then calculate the normal and abnormal returns for the whole event and calculate the cumulative abnormal return around the event window with the use of market-adjusted model and capital asset pricing model. The return on stock and return on index for the estimation will go through a simple regression analysis in Excel to evaluate the relationship of the two variables. Based on our results for CAR and as seen on the presentation, banks from numbers 1 to 5 have the results of accepting the null hypothesis and rejecting the alternative, since the significance of the abnormal returns on these companies does not have an impact of the prices. Both models are not significant at 10% significance level. And as for the BDO and One Network Bank, the market-adjusted model accepts the null hypothesis. However, CAPM accepts the alternative hypothesis, since in the model of the value for the event window is below 10%, suggesting that the abnormal returns in the 11th-day event window can be partially accepted. This also infers that there were indeed differences in the stock price movement of BDO from the expected returns. Lastly, PBB and Insular Savers Bank accepts the null hypothesis, since there was no significant impact of the abnormal returns on the event window. In RCBC, acquiring RCBC Savings Bank, it also rejects the null hypothesis and accepts the alternative hypothesis, since in both models it has positive abnormal returns during the event, and it also has a significant level of 10%.
Based on the 8 M&As that were selected, the results of the study indicate 75%, that is 6 out of 8, show no significant impact on the event period return. This is consistent with other authors' results. Aside from that, 15% suggests significant impact on the event period returns, with one event being partially accepted with the capital asset pricing model and the other being fully accepted by the two-return model. The results imply that the Philippine banking industry appears to be efficient since the industry does not yield abnormal economic profits. Investors were unable to gain from the announcement the moment it was made public. Furthermore, the study provides a relevant implication specifically to financial regulators and investors. Financial regulators, if there is a case of information leakage or insider trading constituting to new policies and guidelines should be passed. Investors, that would give them a perception as to how companies behaves around mergers and acquisitions announced. End of our presentation. Thank you all for listening.